Today, we're going to tackle a really powerful strategy that kind of flips the whole script on options. We're not talking about wild speculation. We're talking about turning them into a tool for generating monthly income from stocks you already own. We're going to dive deep into the math behind one of the most popular income strategies out there, the covered call.
So just think about this for a second. What if those stocks just sitting in your brokerage account could do more than, just hopefully go up in value? What if they could actually send you a check every single month? Seriously, what if you could turn that static asset into a cash-flowing machine? Well, that's exactly the idea we're going to unpack today.
So here's the game plan. First, we're going to frame this whole thing as making your stocks pay you rent. Then we'll get into the language of options. Don't worry, I'll keep it super simple. After that, we'll actually build the covered call strategy piece by piece. We'll run through the real math of the 3 possible outcomes, and then, this is important, we'll talk about the risks. Finally, we'll wrap it all up to help you figure out if this is something that fits your style.
Okay, let's start with the big picture. Why on earth would anyone do this? Well, the goal is pretty straightforward. It is all about the quest for cash flow. It's about taking something you already own, your stocks, and making them work a little harder for you, generating a regular income stream, kind of like a landlord collecting rent on a building they own.
At its absolute core, this whole strategy boils down to one simple concept. You get paid right now, in cash, for making a promise about what you might do with your stocks later. And that payment you get right up front, that's called the premium. That premium is the income. It's the rent check we're looking for.
Now, before we get into the nuts and bolts, this is really crucial. There's a saying that goes, you can't earn before you are learning, and that is so true here. Options have their own set of rules, their own language, and you absolutely have to understand them before you even think about placing a trade. So let's build that foundation right now.
All right, so let's take that advice. Let's learn before we earn. See, before we can put the strategy together, we have to be able to speak the language. These next few things are the absolute fundamental building blocks, and getting them down cold is essential.
So this right here is the single most important relationship in the entire options world. You've got 2 sides. On one side, you have the buyer. The buyer pays money, that premium we talked about, to get a choice. They have the right to do something, but they're not forced to. On the other side is the seller. And for everything we're talking about today, that's going to be us. We, the seller, collect the premium. And in exchange, we make a promise and accept an obligation. It's almost like you're an insurance company, and the premium is what you get paid for selling that policy.
And let's be clear about that premium. This is cash that hits your account the second you make the trade. It's non-refundable. The buyer can never ask for it back. For us, the sellers, the premium is the income. It's the whole reason we're even doing this.
Next up, the strike price. Just think of this as the official price that's locked into the contract. It's the line in the sand. It's the specific, pre-agreed price per share where the deal happens if the buyer actually decides to use their choice. Everything revolves around this number.
And every single option has a shelf life. That's the expiration date. It is a hard deadline. The buyer's choice only exists until this date. If they don't use it, it literally disappears and the contract becomes worthless. And you know what? That's fantastic for us as sellers, because the simple passage of time, what traders call time decay, is always working in our favor.
Okay, finally, there are 2 main flavors of options. You've got call options and put options. A call option gives the buyer the right to, call the stock away from you, to buy it at the strike price. A put option gives them the right to put the stock to someone, to sell it. For this entire explainer, I want you to just focus on one thing. We are selling call options. That's it.
Okay, with that basic language down, let's bring out the star of the show, the covered call. This is where we put it all together. We're going to combine owning a stock with selling one of those call options to create our income stream.
So what in the world is a covered call? Well, think of it like a simple recipe. Step 1, you need to own the stock, specifically at least 100 shares. Why 100? Because one option contract always represents 100 shares. Step 2, you sell one call option contract against those shares. Step 3, by selling it, you're giving someone else the choice to buy those 100 shares from you at that strike price you picked. And step 4, this is the most important part, the reason it's called covered is because you already have the stock. You aren't making some wild promise to sell something you don't own. Your promise is covered, which makes this a much, much lower risk strategy.
All right, now for the part you've been waiting for. This is where the rubber meets the road.
Let's walk through a hypothetical example and see exactly how the numbers shake out. We're going to break down the only 3 things that can possibly happen by expiration, and we'll calculate the profit for each one.
Okay, let's set the stage. First, you go out and buy 100 shares of a company. Let's just call it stock XYZ. It's trading for $50 a share, so you've invested $5,000. Right after you buy the stock, you sell one call option against those shares. You pick a strike price of $55, so above where the stock is now, and you pick an expiration date 45 days away. For selling this contract, for making this promise, you instantly get $200 deposited right into your account. That's your premium.
Okay, so fast forward 45 days. Time's up. Let's go through the 3 possible outcomes here, row by row. First scenario, top row. What if the stock price ends up below our $55 strike price? Let's say it's trading at $52. Well, the buyer has the right to buy from you at $55, but why would they? They can get it cheaper on the open market, so they won't. The option expires worthless. You get to keep your 100 shares, and you keep that full $200 premium. Your total profit is the $200 premium plus the $200 the stock went up for a total of $400. This is a good outcome. Now the middle row, the sweet spot. What if the stock lands exactly at $55? Same thing. The buyer isn't going to exercise. The option expires worthless, you keep your shares, and you keep the premium. Your profit is the $200 premium plus the $500 your stock gained for a total of $700. This is our best outcome. Finally, the bottom row. What if the stock just takes off and blows past $55? Let's say it goes to $60. Now, the buyer will exercise their right to buy from you at that cheaper $55 price. Your 100 shares get called away. You have to sell them for $55 each. Your profit is the $500 you made on the stock, plus that original $200 premium you pocketed. Your total profit is, again, $700. See what happened there? Your profit got capped, but it's still your maximum possible gain.
And this really shows you the power of the strategy. I mean, think about it. In our best case, we made $700 on a $5,000 investment. That works out to a 14% return in just 45 days. This is how you can really start to generate significant cash flow from a portfolio, way more than you'd ever see from just dividends.
Now, as incredible as that sounds, let's be real. There is no free lunch in the world of investing. Every single strategy has trade-offs, it has risks, so we need to be very, very clear about what you're giving up and what could actually go wrong.
And this quote right here just nails the central trade-off perfectly. When you sell that call and you collect that premium, you're doing something great. You're lowering what's called your cost basis, which is just the net price you've paid for the stock. But in exchange for that income, you are absolutely 100% capping your potential gain.
So let's talk about the 2 main risks. First, and this is the big one, is opportunity cost. In our example, if that stock had gone to $70 a share, you'd still be forced to sell at $55. Yeah, you made a nice $700 profit, but you would have missed out on another $1,500 in gains. Your upside is capped. The second risk is just the stock goes down. This isn't some magic shield. If your $50 stock drops to $45, you've still lost $500 on your shares. That $200 premium you collected just acts like a small cushion, reducing your net loss to $300. It only provides a little bit of downside protection.
But what if you sell a call, the stock starts to climb, and you get a little seller's remorse? You decide you really don't want your shares to get called away. Well, pros use a tactic called rolling to adjust the trade. Think of it like this. You're extending the contract, but with better terms for you. First, you buy to close the option you sold. That cancels out your promise. Then, in the same motion, you sell to open a brand new one. You roll up to a higher strike price, which gives your stock more room to run. And you roll out to a later expiration date. And because that new option has more time, it usually brings in a bigger premium, often big enough to cover the cost of buying the old one back. It's a way to stay in a winning trade that you still believe in.
Okay, so we've covered the what, the why, and the how. We've dug into the math, we've looked at the risks. The last question is, who is this actually for? Let's just zoom out and look at the big picture to help you decide.
Let's just boil it all down. First takeaway, this is an income strategy. Its main job is to generate cash. Second, it absolutely caps your upside. You are trading away home run potential for consistent singles and doubles. Third, it lowers your cost basis on the stock, which gives you a small buffer if the price falls. And fourth, this strategy really shines when you're neutral or maybe just a little bit bullish on a stock that you'd be perfectly happy to own for the long haul anyway.
And really, that leads us to the final question, the one you need to ask yourself. Are you the kind of investor who's always hunting for that next 10-bagger, that explosive growth story? Or are you the kind of investor who would rather methodically build a portfolio that pays you a steady, consistent income, month in and month out? There's no right or wrong answer here.
and knowing which one you are is the key to deciding if selling covered calls is the right move for you.